Good afternoon, everyone. Welcome to the conclusion of our three-part series on fraud, featuring forensic accountant Denise McClure. This is Jeremy coming to you today. Jeremy, I'm here with Cougar Mountain Software. I'm actually a trainer here at Cougar Mountain. Been with Cougar Mountain for quite a few years now. A lot of you that are on the webinar today probably recognize me from past webinars and training sessions. So it's good to have you here with us this afternoon. We are excited here to have Denise with us. She has 30 years of experience in public accounting, business management, and nonprofit board involvement. She's a certified public accountant and certified fraud examiner. She focuses on reducing risk by creating checks and balances in financial processes and teaching business owners, boards of directors, and employees how to achieve transparency and accountability. And we also have a handout for you guys out there that are logged on with us today. So if you want to go ahead and click on that handout to follow along, it's our slides here for the presentation with places where you can take notes as we go through the presentation today. So with that, I'll go ahead and hand off to Denise here.
Thank you, Jeremy. Welcome, everyone. I appreciate being here and the opportunity that Cougar Mountain Software has given me to help people increase their awareness of the risk of fraud and embezzlement in small and medium-sized organizations. Today we are building on two previous seminars. The first one we did a couple weeks ago, and it focused on nonprofit board member duties, the fraud triangle, and I gave a fairly high-level review of some tools for mitigating the risk of honest errors and dishonest acts. In the second webinar, we focused on deterrence, and today we're going to focus on corporate culture, or what we accountants like to call the tone at the top. I will apologize in advance that I have a cold, and so I hope you can understand me throughout this seminar. If you can't, go ahead and raise your hand and we'll be able to see it on the organizational panel here. Internal controls are designed to do more than just inhibit fraud. I've been through this in the other two webinars, and so I'm not going to go into detail here, but basically there are a lot of company assets that they can protect, not just the cash and checks coming in, and reputation would be one of those. That internal controls help keep honest people honest, and that protects employees, donors, and beneficiaries. It allows an organization to identify both honest errors and dishonest acts, and the key is that you do that in the normal course of operations. And because you do that, it helps assure valid, reliable, and timely financial reporting. And all these things combined help assure that an organization will achieve its mission and its goals. So really, internal controls are about much broader financial stewardship than just fraud. Fraud tends to be the worst case scenario. But if you take these steps to prevent and deter fraud and to have a good culture of your organization, you're going to be protecting your organizations in several ways. So a culture of integrity is one of the foundational elements for internal control. In previous seminars, we focused on segregating duties so that no one controls a transaction from beginning to end, and providing oversight, which is what was in the last seminar, to create a perception of detection that would deter somebody from committing fraud in your organization, even if they see that they have an opportunity to do so. The culture of integrity is really it's a foundational element. You need it for all the other control elements to be effective. You need open communication to help keep people focused on your mission, and then you need segregation of duties and oversight as kind of additional elements of the system. You always want to balance your segregation of duties and oversight because they're based on the number of staff that you have, they're based on the skills and abilities of your staff, they're based on your budget and your accounting system capabilities. There's no one right way to do it, and it's always going to be a balancing act. Regardless of how you implement what I call the trust but verify principle, you're going to need a strong, healthy culture that keeps people enthusiastic and working together to achieve your organization's mission. In the last webinar, we talked about perception as a tool to deter dishonest acts, and we used it as a way to counter the perception of opportunity that a would-be fraudster acting on impulse, or an otherwise honest person acting on impulse, would cross the line and succumb to the forces of the fraud triangle. Today we're going to talk about culture as a perception. So take a minute to think about how your employees, your volunteers, grantors, and other stakeholders of your organization would describe the culture of your organization. Jot down a few adjectives of what your perception is and how the perceptions of your employees would agree or disagree with that. And then we'll use that later to compare and contrast your perceptions with some negative characteristics of corporate culture that have been in the media recently, as well as positive characteristics that can help you achieve your mission. So how can you, as a leader in your organization, create a culture of integrity within it? First of all, let's talk about culture. Culture is really the personality of an organization, and it's shaped by the values, the beliefs, the behaviors, the principles that make up your personality. It's really a perception by others, by your employees, by your volunteers, by your grantors, by anyone who's a stakeholder for your organization. It's their perception that is based on everything that leadership says and does. If there is any kind of a discrepancy between what the leaders say and what the leaders do, the perceptions are generally going to be based on what they do, because action is far more powerful than words. Everybody leads by example, whether they intend to or not. So culture is shaped as much by informal behavior and perceptions as by formal tools such as a code of conduct, the policies and procedures that are inherent in an organization, the employee handbook, all of those things that are in writing. So we're going to talk about a case that's been in the media recently of a negative corporate culture, and one where the behavior and incentive plans were not consistent with the organization's stated values. And then we're going to talk about how to pursue developing a culture of integrity when values and behaviors are aligned. So everyone has probably heard of the Wells Fargo issue. This is an example of a culture of integrity that is not consistent. The behavior of the organization is not consistent with the organization's principles. Wells Fargo had a reward system that was based on employees trying to achieve unrealistic goals. And it led to employees, because these goals were unrealistic, it led to them taking advantage of customers by opening about 2 million accounts without customers' knowledge. And they were rewarded for that. Employees were rewarded for it, and managers were rewarded for it based on the incentive system that they had in place at the time. So I went online and looked up the values of Wells Fargo as they put in print. And they have 5 values. They see people as a competitive advantage. And I'll just go through each of these and read a little bit from their website about what their vision and values are. About people as a competitive advantage, they called their employees team members rather than employees, and I'm quoting here, because our people are resources to be invested in, not expenses to be managed, and because teamwork is essential to our success in helping customers. They go on to say that products and technology do not fulfill the promise behind a brand. People do. People who are talented, motivated, and more energized than our competitors. And what did they have to say about ethics? Honesty, trust, and integrity are essential for meeting the highest standards of corporate governance. We strive to be recognized by our stakeholders as setting the standard among the world's great companies for integrity and principled performance. This is more than just doing the right thing. We also have to do it in the right way. What's right for customers? We value what's right for our customers in everything we do. One of our top priorities is protecting customers' confidential data and information. Customers trust us to use that information to provide them with products and services that can save them time and money. What Wells Fargo actually did with the incentive system that they developed was contrary to these 3 values. Diversity and inclusion less so, and I think that's self-explanatory. But on the issue of leadership, their website claims that We want all team members to be able to lead themselves, lead the team, and lead the business. We have the responsibility to be the link between the vision of Wells Fargo and our customers. This is not the exclusive domain of managers. We define leadership as the act of establishing, sharing, and communicating our vision, and as the art of motivating others to understand and embrace what we do. A couple of employees at the Wells Fargo headquarters in San Francisco were quoted in the media as saying, "The whole foundation of Wells Fargo is cross-sell, cross-sell, cross-sell." A second one said, "We were all miserable and it was just soul-crushing to walk in every day." Apparently the managers at Wells Fargo would pull employees aside if they were not meeting their incentive goals, and they would have one-on-one coaching sessions with them where they basically told them that their job was on the line if they didn't start to meet their targets. It seems that the behavior of managers and leaders within Wells Fargo was not consistent with their stated values. Their stated values are well described on their website, and I'm sure were presented to employees in different ways throughout the organization. But the problem was there was this huge disconnect between what their stated values were and what the behavior that they promoted and tolerated within the organization. Let's look at some examples of what not to do to build accountability in an organization. This is taken from the book Culture Without Accountability, what WTF, which I need to say stands for What's the Fix. And Julie Bedford and Brian Miller are HR professionals, and they identify all these types of behaviors as examples of accountability failures. If these behaviors are common, or there are specific individuals who exhibit several of these behaviors in your organization, you probably have an accountability problem. People are clearly not doing the right thing at the right time and in the right way. So if Wells Fargo and this list don't exemplify integrity, what does? Well, I've said throughout all three of these webinars that accountability and transparency are extremely important to a culture of integrity. And to me, accountability means that you're doing the right thing at the right time in the right way. And you could add to that, in the right place. A culture of integrity means that people accept responsibilities for their actions, that they have a sense of ownership in their work and that they take pride in their work, that they feel engaged and are enthusiastic about their work. Transparency is all about open communications. It's knowing that leaders expect them to fulfill the mission of the organization and trust them in fulfilling the mission of the organization, that everybody's on the same track and everybody's in the same place. Communication is really key. Employees have to know, is it okay to fail, or what do I do if I make a mistake? Do I cover it up or do I own up to it? What will happen if I own up to it? Will I be retaliated against? What do I do if I see somebody else doing something wrong, or something substandard, or something that I think goes against the value of our organizational system? So transparency is simply operating in a way where it's easy for other people to see what actions are being performed. And it really relies on open communication and having trust in leadership. So in addition to accountability and transparency, open communication is absolutely critical. Are people comfortable expressing the concerns that they have about things that are going on in the organization or the path that the organization is taking? Can they trust their colleagues to do the same? Or is there fear of retaliation of some kind? Do people take responsibility for their actions? Do they have a sense of accomplishment for achieving goals, compared to, say, having a victim mentality or being habitually tardy and just showing up to collect a paycheck? Are they engaged and do they feel empowered? Are they committed to the mission? Do they enjoy working with others and generating ideas for how they can do things better and do things differently to achieve the mission? An important lesson that Wells Fargo teaches us is, do they have realistic targets and goals? Are the goals reasonable? Are they realistic? Are they communicated in such a way that they don't contradict the values of the organization? Sometimes leaders focus on what needs to be done but not how, and that was one of Wells Fargo's failings. They focused on the bottom line and achieving these unrealistic targets, but they didn't talk about going about achieving the goals in certain ways. So it's just important to have organizational goals, but it's important to know how the goals are going to be accomplished, and the two go hand in hand. So do organizational goals focus on bottom line results without regard to how the goals are being accomplished, or do they focus on both? Wells Fargo has a code of conduct. A lot of large organizations, and especially public organizations, are required to have a code of conduct, and you can find thousands of them online. And a code of conduct is great, but it's only an effective tool if the leader's behaviors and expectations are consistent with the standards in the code of conduct. I worked for an organization once that had a 2 to 3 page code of conduct. It was written in teeny tiny type on 3 sheets of paper, and we had to sign it every year to say that we would that we understood and agreed to abide by the code. The problem was it was perceived, because it was such a complex document too, it was perceived as being more of a CYA exercise, and you knew if you didn't sign it that you would be terminated. So as long as it was a condition of employment, people would sign it without necessarily reading it. And that's not an effective code of conduct. You want to make sure that it sets expectations and standards, but does so in a fairly simple and straightforward way. You want to be able to define the boundaries of acceptable and unacceptable behavior, and then you want to take all the standards in your code of conduct and weave them through the organization. So talk about them at meetings, hold people out, and recognize people who have behaved in ways that are exemplary. Use posters and payroll stuffers and several different ways to promote them to employees. Don't just have employees sign a document once a year and that's it. Culture is really a perception. If leaders say one thing and behave in ways that are completely contrary to that, like at Wells Fargo, then the culture is going to flow from the behavior and not from the vision and values of the organization. So if you want to develop a culture of integrity, you have to deal with some of these softer issues that we've discussed so far. I have a couple of tips I'm going to share with you now about some other things that you can do that are a little more hands-on and things that you can implement pretty quickly and easily. One is to do background and criminal history checks. You want to avoid hiring people who are going to be predators in your organization. The Association of Certified Fraud Examiners in their biannual surveys, ever since 2002, they've asked the same question, and that is for people who have investigated cases and are reporting them as part of the survey, was the suspect or the perpetrator, had they ever been previously terminated or convicted of a fraud-related offense? And only about 5 to 15% of people have. But those 5 to 15% of people are the ones that you do not want to hire. So doing a background and criminal history check is an important control because it sends a message to your employees that you want to know who you're hiring. And if you have an individual who is going to be heavily involved in the financial aspects of your organization or a financial manager of some kind, I also recommend that you do a credit check every 1 to 3 years on that individual, because you don't want to retain somebody in a position to manage your financial resources. If they can't manage their own, they're probably not going to be able to manage yours. But I would strongly caution you before you take either of these steps to make sure that you work with a reputable organization who does background and criminal history checks, and also one that can counsel you, because there are a lot of regulatory issues and laws surrounding these issues, and you want to make sure that you have an attorney or someone who can counsel you on what happens if you get some adverse information through one of these channels. It's important to know how you can and should present that information to your candidate. Criminal history checks have limitations, but I think they're a good first step in making sure that people understand that you only want to hire people of integrity. Another tool that you can put into your toolbox is to have hotlines, and these are called anonymous incident reporting services. They proliferated after Sarbanes-Oxley because in Sarbanes-Oxley, large public companies are required to have anonymous incident reporting services or hotlines. And according to ACFE, tips are consistently the most common method of detection in all the ACFE surveys since 2002. So they typically reduce the magnitude of fraud or embezzlement in these organizations who had hotlines. They reduced it by 40 to 60% in each of the surveys. And they also reduced the duration of it. So the offenders were caught much more quickly in organizations that had hotlines. Essentially, hotlines make it easy for someone to provide a tip to you if they think something's going on. I mean, there is, in part of our culture and our society in the U.S., we have an issue with tattletales. We don't want whistleblowers to blow the whistle on anybody. But there are things that are going on that leadership in an organization may never know about unless somebody does respond and tell someone. And it's much easier to respond anonymously than it is to walk into somebody's office and do so. So people often don't provide a tip because they're afraid of being labeled a tattletale or they're afraid of retribution, and this kind of tool can be fabulous. You know your organizations better than I do, and hotlines can be a double-edged sword because you will get a lot of HR issues reported on them and a lot of things that are not really issues, but people are just disgruntled about something. And every organization has to decide how they want to balance that in their organization. So I'm presenting this as one tool that you can choose to use if it works for your organization. I also have some other resources for you, but before I go through those, I want to invite you to ask questions about any aspects of the webinar series, so not just about the culture of integrity, but for other things as well. And Jeremy is on hand, and he can respond to questions about anything you might have about Cougar Mountain Software's Denali product as well. So while you think of questions, and you can type them in using your the control panel on your screen, and I'll just quickly go through these resources while you're considering that. So Accountability, the Key to Driving a High-Performance Culture is a good book by Greg Buston that goes through a lot of large organizations, but gives a lot of specific examples about how they develop a culture of accountability and integrity. I've already mentioned Culture Without Accountability. Dan Ariely is a behavioral economist, a social scientist who's done several TED Talks. He's written books, and he has a documentary called Dishonesty that's fun and entertaining to watch. There's also a biography of social scientist Stanley Milgram, who did some important experiments in the 1960s. And that movie is available on various websites that stream movies and stuff, and it's very interesting. I watched it just about a week ago. Why They Do It, The Motives, Mores, and Character of White-Collar Criminals, which is a relatively new book that's been published. And there's the Corporate Executive Board, which is an organization that does research regarding key drivers of cultural integrity and impact on risk. They strongly recommend doing surveys of employees and other stakeholders, which is a good way to get an idea of the culture of your organization. You may hear some surprises if you undertake something like that. And then there's Philip Zimbardo, who has a good TED Talk, and a book he's published called The Psychology of Evil. He is the social scientist who did the Stanford prison experiment in the 1970s. And in response to those results, he's also developed a nonprofit called the Heroic Imagination Project. They have an interesting website, and they talk about how you can train people not to succumb to the bystander effect, but instead to be a hero when you see something not quite right that's going on in societies. So we're back to the trust but verify principle, which embodies both accountability and transparency. It's about holding people accountable and keeping honest people honest. You don't know what's going on in the lives of your employees. You don't know if they're drowning in a mountain of credit card debt, if they're depressed, if they have an online gambling addiction, if they're going through a divorce, or myriad other things. You want to focus on perceptions when you're trying to impact your organizational culture or your organization's personality. So make sure the actions of your leaders are consistent with organizational values, and that the actions of your leaders and the actions that you propose in your policies and procedures and your incentive plans are consistent with your organizational values. Now I'm going to turn it back to Jeremy for closing remarks.
All right, thank you so much, Denise. It's been a real pleasure having Denise with us here to do this webinar series for us today. So, and for the last 2 webinars that we've had. Okay, so we here at Cougar Mountain, we also believe that your accounting system has an obligation to provide basic internal controls. So we're always look for in-depth user rights that encourage differentiated roles, a tamper-proof audit trail, as well as customizable reports to support transparency, education, and awareness. Our Denali Fund Accounting solution is specifically tailored for nonprofits and offer all of the above features. Fraud is unpredictable, but protecting your organization doesn't have to be. So for a comprehensive demo, go to cougarmountain.com. That's www.cougarmtn.com. Or you can give us a call to request a demo at 1-800-388-3038. So I do have one question here. It's very interesting. The question is, how would you deal with an executive director with a very autocratic management style? So Denise, if you could help us with that.
I can't believe there's any executive directors with an autocratic management style. No, just kidding. That type of personality would seem to be contrary to the open communication, the necessity of open communication in developing a culture of integrity. But it really depends on the person's listening skills. You can be autocratic and you would want to make decisions, especially if you're trying to maybe bring an organization out of a period of doldrum or downturn. And that's not necessarily bad. I think it would really depend on how good of a listener the person was. So if you're willing to listen to other people and absorb thoughts from other people and seek out ideas from other people, so the people on the front line of your organizations or the managers that work under the executive director, I think that type of a personality style or an autocratic management style would not be inconsistent with a culture of integrity. But again, I think it really depends on how well the person listens and tries to draw out information from the people that report to him or her. But that was a great question. Thank you.
All right, thank you, Denise. Any other questions out there? Okay, doesn't look like we have any others. All right, well, it's been a pleasure having you all here with us today. Again, we do want to thank Denise for being here for the last 3 webinars, and we hope to have her back again sometime soon for additional information to provide her expertise and experience. And with that, that will conclude our webinar series for this particular category, dealing with fraud and fraud prevention. Thank you all for attending. Have a great day.